S&P 500 futures are slipping about 0.25% right now, hovering right in that 7,429 to 7,440 range. Nasdaq 100 futures are taking a much harder hit, down roughly 0.8%, while the Dow is just, sitting completely flat. The overarching catalyst here is that the market is paralyzed, waiting for the big tech earnings slate: Microsoft, Meta, Amazon, and Apple, along with tomorrow afternoon's Fed interest rate decision.
But the bond market is telling a different story entirely. You can't just look at the equities drifting and call it a quiet morning. The structural risk here is that institutional capital is intentionally freezing the tape. They are in a defensive crouch.
The technical levels we are tracking explicitly define this as a liquidity trap. For the S&P, bulls have to physically push the index above 7,460 to target 7,500 today. But if we fail and drop below 7,400, the briefing outlines a trapdoor straight down to 7,370.
And that trapdoor isn't just some psychological barrier. It's a literal void in the order book. If you break 7,400, there are virtually zero institutional bids waiting to catch the fall. The price just goes into a vacuum until it finds the next liquidity cluster at 7,370.
Which means if you are holding positions without calibrated stop losses, you are completely exposed to a sudden 30-point air pocket. We have hundreds of billions of dollars in AI infrastructure spending on the line this week, yet these massive trading desks are just sitting on their hands.
The real risk here is algorithmic noise. The institutional tape readers are staying out because any price action that happens before we get hard numbers from big tech is entirely artificial. They are explicitly bracing for false breakouts and stop runs.
Right. The algorithms push a stop price just high enough to bait retail money into buying the top, and then the institutions instantly distribute their shares and crash the price.
Exactly. Or they trigger a stop hunt by dumping shares to hit the retail stop losses, scooping up the discounted liquidity, and snapping the price right back up. Professional desks refuse to be cannon fodder in that kind of mid-range chop.
Looking at the primary pre-market gappers, the crossfire is hitting semiconductors the hardest. Micron Technology is down 4.6% on heavy volume, and Applied Materials is dropping over 3.5%. The buzzwords crossing the desk are AI capital expenditure fatigue and circular financing jitters.
But look at the overseas flow. Micron isn't selling off in a vacuum. The catalyst is the Shanghai debut of Chinese rival Chongqing Memory Technologies. CXMT entering the public market triggers immediate structural fears about memory chip oversupply,
which instantly compresses Micron's pricing power. The institutional line in the sand for Micron this morning is exactly $900. Buyers desperately need to reclaim that level to save the high bandwidth memory thesis for AI data centers.
That's completely erased if we break 860. The institutional models show that a breakdown below 860 support opens the floodgates for a sector-wide contagion, dragging the broader Philadelphia Semiconductor Index all the way down to the 820 level.
I want to isolate these circular financing jitters mentioned in the flow. The data suggests big tech is funding smaller AI startups, who then turn around and use that exact same venture capital to buy cloud computing space from those exact same big tech companies.
It's a closed loop. There's no real organic end-user demand entering the system in that scenario.
So if the macro environment tightens and that venture funding loop breaks, the multi-trillion-dollar valuations built on that artificial revenue stream just evaporate.
Which is precisely why capital is rotating this morning. Institutional money is de-risking from those high-beta speculative tech names and aggressively moving into the physical economy. They are hiding in industrials, specifically aerospace and logistics.
Boeing is the primary mover there. They just reported Q2 commercial deliveries surging 14% year over year to 171 aircraft. More importantly, the FAA officially restored their authority to issue final airworthiness certificates for the 737 MAX and 787 jets.
That regulatory shift fundamentally alters their algorithmic pricing. Reclaiming the $215 resistance level confirms their production momentum and sets a hard target of $225.
But if they fail to hold the line,
if the tape breaks below 205, the market interprets that as proof of lingering supply chain bottlenecks, and the algorithms will immediately dump it to test the $200 psychological floor.
We are also tracking a massive corporate governance referendum this morning with PayPal. They report Q2 earnings right after the board rejected a $53 billion take-private proposal from Stripe and Advent International. That offer was priced at $60.50 a share.
The earnings print is a direct stress test of that rejection. Management now has to mathematically justify turning down a guaranteed premium.
If they beat targets and expand margins, the automated buying programs will push the stock to test that $60.50 buyout anchor.
But if their guidance misses by even a fraction, Support at 54 immediately fractures, and they slide straight back to 50, institutional money will ruthlessly punish them for leaving that cash on the table.
Universal Health Services is a perfect example of that ruthless forward pricing. They posted a massive Q2 beat across the board, but the stock is down 4.2% pre-market purely because management slightly lowered their 2026 profit guidance.
The market is stripping away all speculation. Portfolio managers only care about undeniable future free cash flow right now.
And the overarching macro overlay driving this rotation is hostile. The U.S. 10-year Treasury yield is holding elevated between 4.62 and 4.64%. That's a 24 basis point spike just this month. Meanwhile, the U.S. dollar index, the DXY, is flexing right at 101.50.
Both of those metrics are acting as an absolute anvil on the tech sector.
The pre-market briefing explicitly labels them a clear headwind. The mechanics are straightforward. You have capex cost inflation, where higher risk-free rates drastically increase the cost of servicing the debt needed to build these massive AI data centers.
Yes, but the real structural damage comes from the discount rate penalty. High-growth tech multiples rely heavily on profits projected a decade from now.
Right, the long-duration growth model.
Exactly. And when the 10-year yield guarantees a 4.64% return today, institutional models use that higher yield to discount those future tech earnings. It mathematically crushes their current stock valuation.
Couple that with the FX drag. A DXY holding at 101.50 means a strong US dollar, which actively erodes the overseas revenue for multinational megacaps when they convert foreign sales back into dollars for their quarterly prints.
This specific macro setup triggers what the desk is calling the retail pain trade.
The flow indicates retail investors are aggressively buying the dip on these tech names, assuming AI tailwinds make the interest rate environment irrelevant.
It's a fatal miscalculation of risk. If an institutional portfolio manager can lock in a guaranteed 4.6 to over 5% yield on risk-free treasuries, their threshold for buying a cash-burning tech stock goes through the roof.
The margin for error is zero.
Literally zero. Big tech is burning record cash right as the cost of capital hits multi-year highs. If they miss earnings by a millimeter, institutions instantly liquidate and rotate into cash-generative value stocks. Retail gets left holding the bag.
The primary takeaways for this session are defined. The tape is locked in a liquidity trap. Capital is abandoning speculative AI for mature industrials. And the risk environment is entirely dictated by the macro levels. For anyone managing risk today, the hard resistance lines to watch are 4.70% on the 10-year yield and 102.00 on the dollar index.
If the data pushes those macro levels any higher, it triggers immediate algorithmic devaluation across the equities board.
We will leave you with this structural question to model out. If these elevated borrowing costs force big tech to abruptly pull the plug on their massive debt-fueled AI infrastructure spending, what happens to the thousands of downstream startups whose entire business models rely on the absolute assumption that AI computing power will just keep getting infinitely cheaper?